second. There we go.
Okay, excellent. Okay, now it's official. We're now going to officially be starting. So welcome everyone. Thank you so much for joining us. My name is Emily Gasner. I am the VP of Strategic Initiatives for CAMEO, as well as I'm the director of CAMEO's CDFI incubator. And our incubator is a set of resources, training, funds, lending capital, loan loss reserves, all the things that newer and emerging CDFIs who are microlenders need to scale their impact, as well as training and resources for more established CDFIs as well to tap into. So really pleased to have you join us for our webinar today. And let's see. Let me see here. Oh, right. Okay. So you are in the right place if you are looking for the kind of information on selling your loans today. And I'm just going to briefly go through the agenda and then we're going to kind of get started. So we're going to cover today, you'll get to meet the panelists. I'll have them introduce themselves. You'll learn about EBA Fund and the guarantee program. And how the guarantees can help you sell loans more easily and for higher prices, and just all things related to the guarantee and the loan sales structure. Then we'll have Q&A and wrap up. And I did want to mention that we do want this to be as interactive as possible. So if for example, one of our panelists is talking on a particular topic or on a particular slide and you would like to ask a question right then and there, feel free to pop your question into the Zoom chat, or even kind of unmute yourself or raise your hand and just ask the question. And we'll do questions that way, but we'll also have time at the end as well. And I wanted to give a brief shout out to the U.S. Small Business Administration, because part of this webinar has been funded, the expenses through some funding from the SBA. So we just wanted to say thank you to the SBA. And with that, I'm going to hand it over. Oh, and one other thing is Rajay Connolly from CAMEO, who is here. If you want to direct message her, if you have any technical issues during this webinar, she can help you troubleshoot those. So feel free to reach out to Rajay or to myself, of course. Thank you, Rajay. And with no further ado, I will hand it over to our panelists to introduce themselves. Brett, would you like to go first? And then I'll let you take it away. Thank you.
Yeah, so I'm Brett Simmons. I'm the managing director with EBA Fund. And today I'm going to talk about what we do and some of the partners we work with and how you might be able to get involved with EBA Fund in the year ahead.
Good morning, everyone. Juan Carlos Hernandez, President and CEO of California Southern Financial Development Corporation. We actually do a lot of work with iBank as far as the state small business guarantee program. So welcome.
And I wanted to encourage people to turn on their videos if you are comfortable doing so, if you're able to do that, just so we can kind of see your faces and kind of see who's in the room. That would be extra helpful if you're able to do that. We encourage you to do that. Thank you.
Okay, so I'm going to jump right in and try to share my screen here. So let me know if you can see it.
Yes, we can see it.
Great. So I'm going to go through some slides initially here. It's hard for me to see everyone when I'm sharing my screen. So if you do want to ask a question, maybe try popping in the chat, or I'll try to pause so you can jump in. So EBA Fund stands for Entrepreneur Backed Assets Fund. That's the long name, so we go by EBA. And the real intent behind EBA Fund is to try to take assets that CDFIs originate, small business loans, and turn them into additional capital and additional revenue. We're going to talk about how we do that. Maybe. Here we go. So I think importantly, we're trying to help organizations achieve scale. So our goal is to help organizations grow. And I think it's important to keep that in mind as we go through some of the slides today. When you sell loans, you take part of your portfolio and get capital back right now. And it's important that if you're doing those types of transactions, that you have a plan for that capital as it comes in, and you're ready to deploy it. And if you were selling and not ready to deploy, it wouldn't really be a great solution. So scale is an important part of what we're trying to achieve. And we think the way that we've structured this gives organizations a lot of additional flexibility to make their microlendings more successful. So there are 3 things I want you to remember today. So if you forget everything else we talk about throughout the rest of the presentation, you can always come back to this slide. This is what really matters. So I think everyone already knows the importance of microloans for entrepreneurs of color and women entrepreneurs, especially businesses in low to moderate income census tracts. We always like to start there because that is our mission at the end of the day, is to help you do more lending. And if we can't get that focus achieved, then EBA Fund isn't really serving its role as well as we could. The second piece is that we believe microloans are really important, and we want to improve the economics of doing those loans. We all know that a lot of small dollar loans, they don't generate a lot of interest income. They cost just as much to underwrite. So at the end of the day, it's very difficult to make ends meet as you're growing your microloans. And our marketplace is designed to make raising capital and raising revenue easier. And then just where we're at, we launched in 2020. May of 2020, right as the pandemic was starting. We spent that year working with our initial partners to purchase loans and start doing some sales on the secondary market. And then throughout 2021, we've added a lot of new partners in the CDFI space across the country. And then have started to really build out that marketplace with additional transactions. And in 2022, we anticipate that we'll add probably another 5 or 6 CDFIs at least, potentially more depending on interest, and just continue to build out that marketplace to the scale that we think is possible. So I'm only putting this list on here so that I can rep Robert v. Uriel, because he's my California connection. He's been on our board since the beginning and has been a great partner. So I know many of you likely know him and have worked with him. But some of the other names there you might be familiar with. They've been great partners in helping us get this off the ground. Anytime you launch a startup, your board signs up for a lot of work. Okay, so this is a slide with some data that I think if you guys haven't used this data before in your microloan information or when you're talking to funders, it's super insightful and impactful, I think. So if you look at Federal Reserve data, surveying small business owners, what you find is that 76% of Black-owned firms, 63% of Latino-owned firms, 67% of women-owned firms are seeking loans under $100,000. So if you want to serve these target markets and they're part of your CDFI target market, it's very difficult to serve those markets if you don't efficiently do microloans. So 50,000 or under, 100,000 or under, they're extremely important. What we say is small loans also meet clients where they're at. So this is some great data from the JP Morgan Chase Institute. We haven't looked at it before. They followed a cohort of business borrowers over a 5-year period. You can see that purple bar is Black entrepreneurs, the green bar is Hispanic entrepreneurs, and the white bar is white entrepreneurs. What you see across the board is that the Black and Hispanic businesses tended to have smaller revenues and smaller profit margins. And as people who do underwrite loans, you know that you can't do a global cash flow for a large loan if there isn't revenue and profit margin to help pay it back. And so we know that these businesses are smaller and need small dollar loans, and we need to be able to provide them affordably in order to help them grow their businesses and get rid of this difference in outcomes across businesses. You guys have probably seen this data before, but the synopsis is banks don't do as many loans under $100,000 as they used to. And it's a big gap. So, just our perspective again on mission is we do microloans because of who it serves target market wise. Banks have continued to do less and less small dollar loans. So it's important for CDFIs to help fill that gap. And that's why UVA Fund wants to help CDFIs grow. Here's the challenge though. Despite the fact that CDFIs predominantly have portfolios that are entrepreneurs of color. So across our initial members of EBA Fund, 78% of their loans were to entrepreneurs of color. We know that you need operating subsidy to cover the gap each year in your earned income. You have to raise net assets to take on more debt so you can lend in the first place. And your net assets are also donated. And then you have to borrow in order to lend. And as long as that's the only model available to CDFIs to grow, it's going to happen slowly. Because you've got to have surpluses in multiple years to build up those net assets, and then you can borrow a little more, and then over time you can grow, but it can be very difficult to do it in a quick way. And what EBA Fund tries to do is create a different path that isn't entirely reliant on these three things always being perfectly achieved. And as we say, also allowing lenders to grow without being perfect at fundraising. So if you look at the biggest CDFI microlenders in the country, they're very good at fundraising and they're very good at lending. We want to make it so that we can get a lot of lenders that are very good at lending to grow, maybe only marginally good at fundraising, but through EBA funds, we can help them grow more quickly without necessarily always bringing in that operating subsidy in a big way each year. So how do we do that? We basically try to create a business transaction that has always had the potential to exist, but has been difficult to realize, which is that you as a CDFI have a lot of small business loans on your books. Those small business loans are now on my census tracts. They're to businesses with under $1 million in gross annual revenue. And it turns out that there are lots of banks that have way more capital than you do, that are looking for ways to deploy that capital in order to achieve their CRA impact. And right now, when a bank gives you a loan or an EQ2, that goes on their books as a single loan on their retail lending test. What we do is allow them to actually acquire small business loans from your portfolio, and those go on their CRA lending tests. And what we found is that banks like to buy microloans that are seasoned or have a guarantee, because they can go buy, $140,000 loans for a pretty small capital outlay compared to trying to originate those if they can't originate them right now. So we just try to make this equation balance out in a way that makes transactions happen. So we do that through EBA Fund, and there's an initial transaction that happens between the CDFI. So those are all of our CDFI partners on the left there. We purchase the loans directly from the CDFI, and we immediately give them capital. This is important to point out because if you go try to sell some loans to a bank right now in December, they might be interested because it's the end of their year, and they like to buy loans at the end of their fiscal year because they know exactly what their CRA gaps are. But if you go try to sell some loans to them in January, they'll probably say, come back in November and I'll know what my gaps are. What we've realized is that if CDFIs want to grow the amount of loans they sell to banks, they can't be reliant on waiting until November to sell loans and see what happens. So EBA Fund has been set up that we buy loans throughout the year when you need capital. So we'll buy loans in January, and February, and April, and throughout the year when you need capital to deploy. And then we hold those loans until there's someone interested in purchasing them. At that point, we sell the loans to that bank buyer who's seeking additional impact from their capital and also in need of some CRA performance improvement. That capital comes back to EBA Fund at that point because we've already deployed it to you when we purchase the loans. And then we buy more loans from the same CDFI partners. And then the biggest piece here is that we ask the banks to also make donations at the time of the transaction to help you disperse more loans in the future. So we say to the bank, great, you bought $500,000 of microloans. We provided that $500,000 of capital to Accessity. They need additional operating support in order to disperse that $500,000. So we're going to ask you to not just purchase these loans but make an additional donation to help them disperse more loans in the future. And we take that donation and we donate 75% of it back to the CDFIs. 25% is retained at EBA Fund to help us cover our costs, but the rest goes back to you as additional revenue. And with that donation, these transactions end up being much more valuable than your loans would be if they were just staying on your own books. And then what we do is really manage the risk for everyone involved. So Revolve is who I actually work for. We're the fund manager for EBA Fund. I typically wait to say that because it gets convoluted to try to introduce myself as the Revolve Asset Management Managing Director that also works for EBA Funds, but that is the actual structure. And then we use a platform called Loanwell. It's our master processing platform. So when we purchase loans from CDFIs, they upload monthly reports to us. We invoice them. That all happens through Loanwell. We're actually in process of adding an API to Loanwell so that some of the larger CDFIs we work with who purchased quite a few loans from, they're not doing a monthly report. They're just clicking a button and the data comes to us. We work with a company called PayNet, which is an Equifax company. We actually get the loans rated by PayNet, just as another third-party view on the underlying risk. And then CRF provides backup servicing for us. So what that means is you're still the primary servicer of these notes when they're purchased. So you do the ongoing servicing, but if you ever struggled as an organization to make ends meet, or there was some other challenge that you weren't servicing the loans appropriately, we have CRF in a backup role and they would come in and service the loans on our behalf. That's really just to make banks more comfortable. We really don't anticipate ever needing that, but we get asked about it. So we have a contract that and CRF's there if ever needed. And then the final piece here that really comes with Loanwell is the aggregation part of this. And I'll just use an example in California. So we work with Axion Opportunity Fund, we work with Accessity. They're pretty high volume lenders. We also work with Access Plus Capital, Main Street Launch. We're great lenders, but don't have as large a portfolio as the other two do. And we're literally closing a transaction today that has loans from Main Street Launch, has loans from Axion Opportunity Fund. And basically what we're able to do is allow smaller organizations to get the benefits of EBA Fund that you might not be able to leverage and do without that larger portfolio. So we can sell, 20 Main Street Launch loans along with 70 Axion Opportunity Fund loans. And you get the same benefits as if you had the same large portfolio as Axion Opportunity Fund. And then Axion Opportunity Fund and others work with us because we have a national footprint. So they might be able to interest a bank in California, but we can pool together loans from the entire Southwest using loans from DreamSpring or Lift Fund or other partners. And so banks that have a 6-7 state footprint are interested to work with EBA Fund that wouldn't otherwise purchase loans because we're pooling loans from all these different organizations. So we basically make a market that wouldn't exist otherwise.
Hey, Brett, before you jump into the other slide, there were actually two particular questions that I'm not sure if you're going to be able to address later on, or if this is something that you may want to just kind of touch upon. Is one of them is, how is the donation size based on the donations that you were talking about, the banks offering the CDFIs? And then the other question is, what is the price for the loan purchase? Do the loans have to meet a certain underwriting requirement? Yeah. So just to kind of keep that on your back burner to address.
Thanks, Juan Carlos. I didn't see those at all. So appreciate you jumping in. So the donation, it varies, but it's typically ends up being like between $2,000 and $4,000 per loan. So your average loan size is $10,000. It's anywhere from 20 to 40% of the balance. I have found that average microloan sizes are a little larger in California than other states. I'm not exactly sure why that is, but it could be cost of living. I'm not sure, but yeah, it's 2,000 to 4,000. We tend to ask for a little bit smaller donation if banks are going to buy a lot of loans, because it's just way more efficient for us and more efficient for you if the bank buys 100 loans versus 4. So there's a little variability there, but the intent is to drive significant revenue back to you from those donations.
And sorry, Brett, along those lines, did you say that EBA Fund keeps, is it the 25% portion and the CDFI keeps 75%?
Yep.
Okay, thank you. And one other question related to the grants is, are you finding that the bank is then not giving its like annual grant to that CDFI? Is this kind of in addition to, or are they considering this to be instead of like their annual grant that they give?
Yeah, it kind of depends on the bank. In most cases to date, the amount of donation that they're making as part of purchasing loans is so much higher than their annual grant to the CDFI that even if they don't give the annual grant next year, most of the CDFIs are getting 4 to 5 times more donation than they would have otherwise.
Oh, wow. Okay.
There's a lot of banks,
Great.
here's $5,000 or $10,000, $5,000 or $10,000 donation in a single transaction for us is not unusual at all. So it drives more capital back at the end of the day, even if it might exchange some of the donation that you got on an annual basis before.
Thank
Emily,
you.
on a side note with us, I mean, when we did this, when I was over at Accion, it was actually some of the additional funding or the additional money that the banks were providing Accion was in addition to the actual annual revenue as the annual donation, as opposed to including that amount. So basically, we were getting the double donation.
Oh,
Yeah.
great. Terrific.
I think, in many banks' minds, they come out of 2 different buckets. So that's beneficial. So in terms of pricing and underwriting, which was the other question, there's basically 2 approaches we take. So first, it's important to remember these are non-recourse purchases. So when we buy the loans, you're servicing them, but if they go bad, we take the loss. So it's important for us to understand the risk of your portfolio before we purchase loans. The second piece is that how we do that pricing is going to vary depending on the situation. So in the first, there are times when, we might have a handful of loans on our books from Main Street launch. And then a bank comes to us and says, you've got 25 loans, but we actually need 55. So we'll take the 25 you have, we need 35 more. So we would go to Main Street launch and there are other lenders in the Bay Area and say, do you have additional loans? This is what we're looking for. And in those cases, we just purchase the loans at par. So we don't do any additional risk underwriting at that point. If it's a $10,000 loan, you get $10,000 plus whatever the accrued interest is on the closing date. And then in addition to that, you would get the donation once we transfer the loans onto the bank. If you need liquidity, and we don't necessarily have a bank that's interested, so this is that like early in the year scenario tends to be the case. So it's March, you need $1 million to lend. You don't want to go take on more debt. Maybe your net asset ratio is at 25% already, and you're just worried about whether you can take on more debt. We would look at your whole portfolio. We would assess the risk of loss on that whole portfolio. And then we would calculate out what the potential income is on the portfolio and what the potential losses are. Whatever that net position is, plus the loan balance, is the price that we offer the CDFI plus 25 basis points. So we basically want to do the transaction at a price that is income neutral for you. So it's not like you sell the loans and you lose all your income from the notes. You sell the loans to EBA Fund, we've already taken the income and losses into account. And you're just getting the capital right now at a reasonable price. If there's a guarantee involved, we'll talk about that because it changes how we look at the risk of loss. But this is the basic approach. And we do it on your whole portfolio because it's just easier to model. Modeling the loss risk on 5 loans versus 500 loans is just significantly easier. You can just look at the statistical averages rather than trying to re-underwrite every single loan. When we actually buy loans, we buy them in what we call a representative portfolio. So if we analyze your portfolio and there's 100 loans and we said the loss risk is 7%, we then take a bunch of variables about your portfolio, like the industry groupings, the spread of your FICO scores, the age of the businesses, the PayNet scores. And we choose a portfolio out of that 100 that on average looks just like the 100. So if there are 15% restaurants, we're going to buy 15% restaurants. If 10% of your loans had under 500 FICO score, then 15% of our purchases have under 500 FICO score. And we can do that because we've already analyzed the risk on the whole portfolio. So you can underwrite how you want to underwrite. It's going to impact how we look at the final pricing some, but our intent here is not to force everyone to do things the same way. We don't think that's a healthy outcome. It creates a little more difficulty on our side sometimes, but at the end of the day, we think it's the right approach to take. Okay, so here are some questions that always come up. What happens if the loss forecast is wrong? If it's wrong in the negative, so we said it was going to be 7% and it was 10%, UVA Fund just eats those losses. If it's wrong in the positive sense, so we said it's going to be 7% and it was 5%, then we calculate how much additional return we got as a result, and we donate at least 50% of it back to you at the CDFI. So you're basically locking in a worst case outcome when we price your notes. And you have potential upside if they perform better than you anticipated. And then finally, we don't just like declare a loss forecast and then you have to accept what we say. It's typically a back and forth conversation. We say, this is our analysis, this is how we did it. We're totally transparent on that process. If you say, well, this is what we know from our historic average loss, we take that information and that feedback into account. So you don't have to sell a loan until we come to a conclusion that we both agree to on the loss. So what do you gain as a CDFI? You get the capital now rather than waiting for the loans to repay. You don't have to take on new net assets or debt to keep lending. We're a reliable purchaser. So if you guys saw, we had an announcement last week of an additional, basically $18 million that have been invested in EBA Fund, which brings our total capital to date above 25 million. And that's capital that we can deploy when people need to have loans purchased. It's fewer relationships to manage. So, when Juan Carlos was at Accion, they would sell loans to multiple banks, and then you have to manage each of those banks. With EBA Fund, you just have to work with EBA Fund. We do all the work managing all of
them. Hey, Brett, there was one additional question that just came up from John. It said, I might have missed this, but how does EBA Fund sustain itself?
Well, initially we sustained ourselves because of some generous philanthropy from the City Foundation and Wells Fargo. Also the Gates Foundation and a few other private foundations. But our goal is that as we grow, because we retain 25% of that donation on the secondary market sales, if we get to a large enough scale, the EBA Fund doesn't need additional subsidy to exist. That's the goal. So we drive capital back to you. We retain that 25% of that donated amount, and that, at the right size is enough to make this whole thing work. As you all know, I have a great financial projection that shows exactly how that happens, and I hope we get there, but it's still a financial projection. So, but we're on track, so that's good. So I'll stop there and let Juan Carlos talk more about the guarantee program, and we can talk about how it fits in with EBA.
Morning, everyone. Thanks, Brett. Actually, this is really, really wonderful information. I wanted to just basically, obviously, my area to talk about is what makes the guarantee or the loans that have been enrolled in the guarantee program incredibly attractive for the actual purchasing agreement. And most of it is the fact that the actual risk that is already placed is decreased by 80%. Our regular trust fund or our regular state guarantee program, we cover and we guarantee those loans up to 80%. So if you're doing a loan at $50,000, literally your risk is only $10,000. By selling those particular loans to folks like EBA, you're basically sharing an even lower amount in the risk, or you're decreasing your risk even more. What ends up happening is, in order to be able to sell those, it becomes a participation loan. You're no longer selling the full loan to EBA or to any participants. You're going to keep 10% of ownership of that particular loan. You're going to sell the 90% to some folks like EBA. If those loans do become default, you're still able to submit a claim for that 80% plus 90%, 90 days worth of interest. So we'll basically cover that let's say on a $50,000 loan, we give you back a check for $40,000. At that point, you then share, you keep the 10% that you receive, and then of course, that becomes a pari passu type of distribution between you and EBA. The highlight of it again is because of the lack of risk or the decreased risk percentage, it's incredibly attractive to investors. As I'm not sure how many of you as lenders participated in the California Rebuild Fund that was established during the pandemic, that was primarily utilizing the state guarantee program for approximately, we did almost $60 million. And that was incredibly attractive to investors to work with the lenders, again, because of the fact that their risk in these loans were minimal. So they at least knew that they were going to receive a high percentage of their initial investment back. So in those perspectives, it makes these particular transactions relatively attractive. So with our regular trust fund, obviously we go up to the 80% guarantee. Your risk literally, and I'm not going to do the math involved, but the reality is your risk is literally less than 10% of the amount that you put out. So, and again, because of that particular enhancement, folks like EBA, which it becomes a very attractive product. It helps the banks with their CRA, but again, also the decrease of the actual overall risk on the loans that have been enrolled with us. And for me, it works for us because of the fact that obviously the more capital you continue to recapture, the more loans you're going to be able to continue to bring out into the public, into the loans into the clients that need this. So, and again, this is where it becomes working. We were able to work with you as a lender on how to make sure that you work step by step to ensure that you don't lose on the claim. As far as making sure that you do all your due process for collections on any loan that went default, and to make sure that you are able to collect on that 80% guarantee. Juan
Carlos,
yes.
Quick question for you, because we do have some guests I know from like Florida and other states who are joining us. So, so if you could just speak to if this is just specific to California, are there, Brad or Juan Carlos guarantees in other states that might or other risk mitigation tools that would also make for a better loan purchase by EBA Fund?
Unfortunately, as far as the program that California offers with the Small Business Loan Guarantee Program, it is only offered in the state of California. I do believe other states have other types of programs, but it doesn't work exactly like this. They usually work either as a loan loss reserve or to be able to sort of with assistance in any kind of closing costs to be able to obtain those loans from lenders. But as far as the actual guarantee, which works, the best way to express it is we have the way that we work and the way that we do things in the guarantee program is very similar to the SBA 7A, the Community Advantage Program. But obviously we offer this specifically just for the state of California. So these particular guarantee loans do not cover loans in other states.
So there are other states that have like loan loss reserve cap programs and some guarantee programs. Most of those were started through SSBCI. So as your states get funding through SSBCI, we are encouraging people to advocate for programs that help create credit enhancements. The key though is once there's a credit enhancement to ensure that it's actually a credit enhancement that you can transfer. So for instance, the state of Colorado, they have a cap program and they don't allow the CDFIs that lend into the cap program to transfer any interest in the cap program with the loans, even if they do a 90% participation instead. We've told states, you're putting up a small amount of money in a cap program or a guarantee program. And if you allowed CDFIs and others to transfer those assets with the credit enhancement, you would just allow that capital to go even further because you would recycle the capital that much faster and that much more. So California has been ahead of the curve in that regard and allowing both CAP and the guarantee program to be participated in this 90-10 structure. But we do encourage other states and people to try to advocate for that in their state.
Okay, thanks. Thank you. And the transferability is key within that, whatever legislation in your state.
Yeah. Sometimes people don't even realize they're doing it. There'll be a line that says like how this guarantee or is up to the program administrator. That's the typical line.
Ah,
And then the program administrator decides they don't want to deal with transfers. And so they just don't do it. And that's a situation we want to avoid.
thank you.
And for those lenders that are in the state of California, the availability to be able to transfer the ownership or at least the 90% ownership to other, to a partner is incredibly easy. It really just requires for you as a lender to notify us that provide us a list of the loans that are going to be transferred and who they're going to be transferred to. And that's pretty much it.
I have a question regarding documentation. Does the loan agreement or promissory note need to say anything about, participation, assignment, or some? I guess this would be called the syndication in the corporate world. And I know that like syndicated credit agreements have 100 pages devoted to participation language. I just want to see how that works in this side of the globe.
At least, and I can tell you based on my experience when I did this with Accion, is the fact that it doesn't really have to, there is no language that has to be stated. The only language obviously that needs to be stated and as with any loan, whether any commercial loan or even, if you already have a mortgage, there is some language with the availability of of being allowed to sell the loan. There really, to the borrower, it really is very transparent. They have absolutely no clue that what you're doing on the back end, because at you're still servicing the loan. So you're still, in front of that particular borrower.
I guess one additional question is like if say borrower is asking for some sort of a reduction in interest rate or extending out the maturity date or something like that, would the CDFI have unilateral right to sort of negotiate that, or would they do a vote, or would you guys get into it, or?
Yeah, so if you change the terms of the note, it obviously changes the economic outcomes for EBA Fund or for the banks that get the loan transferred to them. So the master participation agreement, which is the agreement that governs how you'll service and work on the loans, basically says if you want to change the maturity date or interest rate, that you have to get permission from EBA Fund to do that. We always approve the first request. But any requests after that, we're going to take a lot of time to look at very closely. Oftentimes we find that more than one restructure doesn't necessarily help the borrower at the end of the day. So we tend to say no to more than one. But we do allow in the agreement that you can unilaterally provide up to 3 months of payment relief to the client. So they're struggling and you wanted to, pause principal and interest payments for 3 months. You're allowed to do that 2 times within the agreement. We just don't want to tie people's hands too much if they feel like that can benefit someone to get through a difficult couple months. Yeah, but generally speaking, there is that review. And then what we've had some CDFIs do is they say, well, this hasn't happened yet, but this is how it would play out. Someone came to us for a restructure and we said, no, we're not going to allow it. Or the bank we've transferred it to said, no, we don't want to allow it. There's nothing in the agreement that says you can't just pay the loan off. So if you really wanted to do the restructure, then you can take the risk back on yourself. So if there's $9,000 of balance remaining, you just refinance the loan as part of the restructure and pay off the $9,000, and you have a new note with the new terms that you wanted to give the customer, and then you would take back on the risk. So at the end of the day, you can always make the restructure happen if you want. It's just going to change where the risk is at.
It sounds like there's a lot of flexibility throughout. And I just wanted to add one thing also to Juan Carlos's point, to Jason's question. When I was at Working Solutions, we did have a boilerplate language in our loan agreements that said we reserve the right to sell your loan to another, to a third party. And so, we just, our pro bono legal counsel just liked us having that in there if we decided to do it or not. It was just kind of a nice thing to have, so that you didn't have to go back and rework anything.
You really just need your agreement to not say that you can't transfer. And otherwise you should be.
Yeah, to Jason, to address the question that you had initially with regards to being able to make some changes or restructure the loan. If the loans are within, if those particular loans are enrolled with the state of California, you would also need to get the concurrence from us as well. We basically within 24 to 48 hours approve those. Very seldom do we ever not approve those requests if it makes sense. The only thing that we are very cautious about is extending the maturity loan or the maturity date more than 4 months. So you can extend it, but we really would rather not extend it more than 4 months from the initial date.
Thank you.
One other thing I just wanted to mention on the guarantee program. And, people do the guarantee programs and they do things like CalCap because it provides benefit when loans go bad, right? So you were going to take a loss of 100%, you're now taking a 20% loss. And that's a really important risk mitigation tool for many CDFIs. And I know many CDFIs outside of California that are constantly jealous of the tools available to California CDFIs. But the reality is you're going to put work into getting that guarantee or other credit enhancement, but you really don't get the value until the loan goes bad, right? So it's sort of like you have to take some risk at the end of the day to have the benefit, and that, but what you can do with EBA Fund is basically get some of that value from the credit enhancement without anything happening to the loan, right? So you come to us and we forecast your losses at 7%. And then the portfolio of loans we select, they're all guaranteed. We basically take that 7% loss rate and reduce it by 80%. So your pricing reflects an 80% reduction in losses. Because at the end of the day, we're trying to give you that income neutral outcome, and there aren't going to be as many losses for us. So we can translate some of that as value back to you at the time of the loan purchase. So just wanted to point that out because it's a little different take on the scenario, but it basically provides additional incentive to get things like guarantees because of the way that EBA Fund at least would price those. And then when we go to banks and say, there's an 80% guarantee on these loans, at the end of the day, for a bank, buying a lot of microloans is not a huge absolute risk, right? You're talking about billion-dollar asset banks purchasing $2 million of microloans. Even if that whole portfolio went bad, it probably wouldn't have a major impact on their absolute losses as a bank. So the guarantee doesn't really, it doesn't like move the needle that significantly on how they look at losses. What it does do is allows them to spend less time contemplating the transaction. And they'll buy more. So they would say, I was going to buy $1 million and I was going to take all this time to try to underwrite all the loans really closely, or I was going to spend an extra 10 hours looking at this loan tape and I was going to have to get approval from this credit officer. And now the credit officer is going to sign off on it in an hour because I've got this credit enhancement. And I'll buy more because I know that my loss risk has gone down. So it's a really important tool for us at EBA Fund to be able to talk to banks and basically say, look, you don't understand microlending. You don't do loans like this. It's going to be hard for you to understand the risk. You're going to look at the FICO scores and get scared. You're going to look at the business age and get scared, like the things that banks will shy away from. But if we can say, and there's a guarantee, it's enrolled here, you're buying a 90% share, your losses are reduced by X amount, it just makes it that much easier to make the case to them that this is a good tool for them on the CRA business side. So with the time we have left, I just want to point out how we're going to be adding partners in the new year. So we have 3 levels of partnership: the preferred partners, and those are partners who have been working with us since the beginning or have already been limited partners or growth partners. And all that means is that with preferred partners, we buy and sell their loans as needed. Because we have experience with them, we understand their servicing, all of that. With limited partners, we initially do one transaction. Typically, there's already a bank buyer involved. And we allow those loans to be serviced for 3 to 6 months before we do additional transactions. And we do that because servicing varies a lot from CDFI to CDFI. We just need to make sure we get on the same page about how things get processed. When we sell your loans onto banks, for instance, we receive a report from you, we reconcile that report, we receive a wire from you, and then we wire those funds to a bank with an additional report. And we have to do all of that in a 4-day period across all the banks and CDFIs we work with. So before we sell loans onto a bank, we want to be certain that you're going to be able to do all of those things on the servicing side. And we look at that in the onboarding process, but we've just found until we actually are working with you on a month-to-month basis, we just don't know exactly how that will pan out. So it's good to have that sort of trial period. So that's what a limited partner is. And typically, these are more experienced partners. So they might be doing 75 to 150 loans a year. So a bit bigger in size. And then growth partners are organizations that are attempting to scale their microlending. And we typically do an initial small transaction just like we would with limited partners, but we also have a monthly meeting with the organization in order to provide additional services to the organization as they're looking to grow. So growth partner like Access Plus Capital or River City Capital, People Trust is another growth partner based in Arkansas. We have these meetings with them where they say, you know, I want to be able to underwrite loans more quickly. What's a way that I could do that? We would say, well, let's look at how you use your loan tier. Let's look at your required document list. Or if they don't have a refinance product, we say, here's a way that you could do a refinance product with less documentation and what it would look like. So we basically provide just some ongoing support to help you scale your lending. Because ultimately we know that we can't just take the largest microlenders in the country and hope that they go and lend in every state, in every community. Like they're never going to achieve the depth of penetration that is really necessary to serve all the entrepreneurs we think could benefit from CDFI capital. We really need CDFIs on the ground that understand their community in each location as well. So we try to be a partner that allows those smaller organizations to grow. And as I said, you know, we can pool a small number of loans in these larger transactions so that your CDFI can still get the benefits of doing loan sales to banks without necessarily being a 1,000 loan portfolio. So we do a review process to add lenders. There's a letter of interest on our website. So if you go to ebafund.org and click for CDFIs, it'll describe this. And then underneath it says the letter of interest. You click that link and it shows the documents that we require. Typically, we start underwriting you when you send us the documentation. Then we have a conversation with you. We sign an NDA. We typically ask for some additional documents at that time. And then it goes to our board, and the board decides if you're a good fit for us. I think one of the things that's come up in some of our reviews is we just need to see a demonstrated commitment to growing. So there's a lot of CDFI lenders that have been doing the same number of loans every year for a long time. There's not anything necessarily wrong with that, but for us, you know, growth is really important. And when you're selling loans, it's hard to just be in a static place, right? Because you're taking a portion of your portfolio and selling it on, and that capital is coming right back. You need to be in a position to deploy it. And that means having a growth mindset. And that's really important to our board when we look at new organizations. Okay, there's my contact info. I'll stop there and see if there's more questions for Juan Carlos. Or did Juan Carlos
had to jump off. So he's left his contact information for anyone that wants to contact him directly, but I wanted to open it up for everybody here. Anyone who has a question, if you could just give your name and organization and ask your question. Feel free to unmute yourself. Do we have any questions? This was very thorough. And Brett, I feel like I've learned a lot personally, so I'm grateful for this information.
Someone asked about other types of loans. So from a mission perspective, we think microlending is really important. And for all those reasons we talked about before. And within the CDFI world, I feel like this is my feeling, but I feel like there's probably data that bears this out too, is that microlending is often sort of like the frowned upon product that everyone wants to offer, but no one wants to offer in a big way because it is difficult. It's not cost effective. It's all those things that CDFIs are like, oh, I want to be sustainable, so I'm going to do less microlending, or oh, I want to be sustainable, so I'm going to do bigger loans. And we're like, yeah, but if you really want to serve these target markets that we think are so important, you need to do microlending. So for us, we want to create all the incentives in the world for people to do microlending. So that's really why our focus is on microloans. The other piece of it is that the reason banks will make those big donations and buy these loans in the first place is because they're able to acquire a lot of units of loans for a small dollar amount. So they could go buy community advantage loans or 7A loans, but they're going to spend $150,000 a pop to purchase them versus spending $10,000 or $12,000. And from a CRA perspective, their performance on their lending to businesses with under $1 million in gross annual revenue and their performance on lending in LMI communities is not based on the dollar amount, it's based on the unit distribution. So a $10,000 loan counts just as much as a $150,000 loan. So banks come to us because it's very capital efficient. And we say, great, you're going to get this benefit because the CDFIs have done all the work. And that's why we're going to ask you for a big donation so that they can keep doing that work and basically create a good incentive structure. So it's a good incentive for the CDFI. The more you lend, the more that donation comes. And for the bank, they're going to get CRA benefit, but we're going to ask them to pay it forward by providing that additional donation.
Sorry, Brent, can you pop your email in the Zoom chat, please?
Yeah.
For everybody? Sorry, I accidentally interrupted someone. Who was that?
I have a question. Hi, Brett. Sarah Sims. I'm with the community development team at the SF Fed. Thank you. This has been great. I'm curious, I guess, one, how many bank clients do you have currently? And just would be interested in what are the biggest barriers from banks? Like what kind of questions or you know, in terms of scaling on that side?
Yeah. So we have 10 banks that work with us right now. Most of them are Fed or FDIC. As you might imagine, some of the bigger national SEC regulated banks haven't been as interested in these types of approaches. And we doubled that in the last 2 months. And so I think every year in Q4, we'll probably increase it. We talk to banks all year and then Q4 hits and our lives end and all we do is try to sell loans. But I think, you know, over the next 3 days, we're closing even more transactions. So it's a good outcome for us. I think in terms of what we hear, I think a lot of it is we do a lot on the front end with our CDFI partners to make sure that they do OFAC screening, that they request the proper identification, that they get EIN numbers from their business, that they have corporate resolutions to borrow, like just basic things that a bank wants to see and needs to see from a KYC perspective and from an anti-money laundering perspective. And some CDFIs don't realize that those are really important. Like they might just not have it in their process or might not have been as diligent about it. So we help all of our CDFI partners make sure that's in place first. It typically takes a lot of conversations with the compliance groups at banks to get them comfortable with the revenue verification, for instance. They're used to seeing a larger small business size, and they've got tax returns or they've got compiled financials and profit and loss from the business, and it's easily available because it's a larger business that has a finance team that can generate it. We're talking about really small businesses, and most CDFIs doing microlending are using, you know, recent bank statements or stated revenue from the borrower in order to make lending decisions. So we've had to spend a lot of time with our partner organizations ensuring that they collect revenue in a way that banks will be comfortable saying to their examiner, yes, I know that this is a business with under $1 million in gross annual revenue. I wish that it was easier with some of those banks, but they're very worried that an examiner is going to come in and say, your $10,000 loan to a CDFI, you couldn't properly verify that it was under $1 million in gross annual revenue. And I want to just be like, really? Like, if the CRA examiner is getting that worried about this microloan from the CDFI, then they're probably missing some other things going on at the bank. But that's the type of stuff that we deal with a lot on the front end, is just making sure that they're confident in how all that's going to play out with their examiner.
Great, thank you.
Which goes to why the whole limited partner and growth partner thing exists. Like all of those things I just talked through, we go through with each of our new partners to make sure that they're ready to sell loans, and that by the time we get to a bank and they look at the documentation on the loan, they're going to feel confident that they're getting what they need from a CRA perspective.
Great. Are there any other questions?
Yes, do you guys have time for another one?
Sure, go for it, Daisy.
All right. Thank you, guys. This webinar has been very thorough. Brett, you had talked or mentioned earlier in your presentation about EBA managing the relationship. What does that look like? Are you guys going to be servicing the loan in connection with our borrowers, or if you can talk a little bit more about what managing the relationship looks like? Thank you.
Yeah, so we don't want to manage the relationship with your borrower. I want to be clear on that. I have no desire to talk to your borrower. I don't want to hear from them. I don't want to know about workouts. I don't want to know about missed payments. I just want to know, like, was the principal and interest payment made? How many days delinquent are they? And then you transfer it once a month with a report. Like, we want you to have that relationship. You provide the technical assistance. You're in the right place to make sure that the loan gets repaid in the first place. So you manage that relationship. What we manage is the relationship with the bank. So we say, we've underwritten this CDFI. We understand their process. This is how they do things. This is what you're going to get from them. This is why you should buy their loans. And typically that means for most banks, it's 3 to 4 different CDFIs might be part of a single pool of loans that they purchase from us. So we're just managing that all those questions the bank is going to ask, so that you don't have to become a CRA expert in order to answer them. And that's really part of the value of EBA Fund. It's like, I can sit down with the bank and talk through gross annual revenue verification because I've done it a bunch of times. You don't have to go become an expert on how to do gross annual revenue verification or any other part of the compliance toolkit that a bank needs to do. And we can have those conversations on your behalf. And that's part of what we had always hoped with EBA Fund, is we kind of centralize that expertise and don't try to make every CDFI into a secondary market expert.
Thank you very much. That was great.
All right. And Brett, I wanted to see, is it okay with you if we share this PowerPoint with the attendees?
Yeah, so you guys have a version of it that doesn't have accessity in it, and I added them.
Okay,
just
if
added
you
them
want to
as a
just
version.
email me the newest one, we'll make sure we
Yeah.
Okay, great. So why don't we, on that note, wrap it up? I just wanted to say thank you so much to Brett, as well as to Juan Carlos, who had to hop off a little bit early there. But just thank you so much for bringing this really valuable information. You know, when I was at Working Solutions, I always was trying to figure out how could we sell our loans and at what point we wanted to do that. And then the idea of working directly with the banks, it just seemed like quite a bit of work, and it just seems like you streamline everything and have it down. So it's really great to hear about this innovative approach that you have. So we've got everybody's contact information here. You'll be getting a follow-up email from us with today's recording, as well as the slide deck. And also, if you're interested in more information about CAMEO's CDFI incubator for microlenders, please contact me. We're currently recruiting for our year-long CDFI Essentials cohort, which is a monthly meeting and ongoing resources for CDFIs that will start in February. So feel free to contact me about that. But otherwise, I wanted to thank you all for coming, and happy holidays to everybody. And please stay in touch. And thank you so much to Brett and Juan Carlos.
Thanks,
Thank you
everyone.
all.